Today we're going to talk about everybody's favorite thing, taxes. Um, so we're going to first look at its effect on supply and demand when we impose the tax on the producer side. So if we're taxing the people making the good, and when we impose the tax on the consumer side. So we're taxing the people who purchase the good. Then we're going to talk about different types of taxes with special emphasis in the days ahead on the distinction between a progressive tax and a regressive tax. So a tax is a government policy that raises funds for government spending. So it's when the government raises money to pay their bills. All right. Government spending includes things like public education, infrastructure, so your roads, national defense, all that good stuff. So an excise tax is what we're going to be talking about for the next few minutes, and that's going to be a tax on a good or a service. So this is what can affect either producers or consumer side, and it's what we're going to be looking at. So if we're taxing our producers $40 per room, our hotel owners, that's going to shift our supply curve up 40. And when you do that, it creates some different areas. So this top one here, this top triangle, that's our consumer surplus. We've still got deadweight loss. By the way, this graph is important, so take a minute, pause the video, write it down. We've got producer surplus in the bottom here. And then this other part, this box, is going to be the tax revenue. So the amount the government's making off the tax. And we'll do some examples where we calculate all those areas in just a minute. So once again, the supply tax on suppliers moves the supply curve up by the amount of the tax. When we were talking about shifts of the supply curve, our description of that movement would be the supply shifting left. All right, you'll notice that our price goes up because of the tax and our quantity goes down, which is consistent with a supply curve shift upward or to the left. That's the effect of an excise tax on consumers. When we're looking at it on customers or the consumers, it's going to impact the demand curve, right? But the same implications apply. So the only difference is now that the demand curve is shifting, and it's going to shift left, just like supply did, by the amount of the tax. So if the tax is 40, it's going to move down 40. We still have those areas, and it looks pretty much the same with our consumer surplus being that top, our tax revenue being this box in the middle, our producer surplus being that triangle on the bottom, and our deadweight loss being this triangle here. So the new thing we're adding to the mix here is tax revenue. So the consequence of an excise tax on consumers is that it shifts our demand curve down by the amount of the tax. So that leftward shift will cause a decrease in quantity and an increase in price. Incidence has to do with who's bearing the burden of the tax. So our producers eating the tax or our consumers paying the brunt of it. And this is going to be talked about in terms of surplus loss. So if we look at our original consumer surplus and our original producer surplus, who loses the most? All right, and that will be the person that's bearing the burden of the tax, and the incidence of the tax will be higher on that group. We've got a couple of examples here of when the incidence of the tax is bared more on consumers and on producers. We're going to look at graphs like this in class together. So pause the video, give it a gander, but we'll be talking about this more in class. All right, so when our price elasticity of demand or our demand curve is flatter, all right, the tax is going to fall on producers primarily. And when our demand curve is steeper, it's going to fall on consumers. This is that same problem that we were talking about before. All right, so same exact graph, just now with the calculations. The tax rate is going to be our amount of tax per unit. So in this case, it was 40. All right, we've got our consumer surplus, our producer surplus, and our deadweight loss. The area for that tax revenue is going to be length times width. It is 40 long and 200 wide. So we multiply those, we'll get 8,000. We could also calculate our consumer, producer, and deadweight loss. Since we've been doing that right along, I neglect to do that here. All taxes come with an administrative cost. That's going to be the cost of administering the tax or implementing it. So we have to pay people to audit the tax. We have to pay people to keep track of who's paid their taxes, right? All of those costs come out of our tax revenue. And then this is kind of the obvious part we were talking about, right? All taxes cause producer and consumer surplus to be lowered, where A and C are going to be that money the government's taking, the tax revenue, and B and F are going to be the deadweight loss. We've got a couple of principles we're going to talk about. All right, the benefits principle, which says that the people who benefit from it should be paying the tax. So people who use the highway should be paying for the maintenance. So that would be like a toll. They're saying, well, people who ride on it need to help contribute for its maintenance. The ability to pay principle says that consumers or producers should pay what they're able to. All right, if you make more, you should pay more. And then we've got this idea of a trade-off between equity and fairness. So equity is this idea of people paying what they can, so an equitable amount, versus efficiency, which is where you're doing it the most, like the easiest way possible. Oops. All right, so now we've got just some specific tax vocab to dig into. So a tax base is going to be what determines how much an individual or firm pays in taxes. So that's going to be like your taxable income. If you're a company, that's going to be your real estate, all that stuff. Tax structure is what takes our tax base and turns it into revenue. So for our tax base is the monthly salary of an employee, which is $3,000. The tax structure is going to be, well, we're taxing 10% of that $3,000, which turns it into the revenue of the revenue end that the government gets. And now we have our types of taxes. We've got lump sums, which is just a fixed amount. So that says every, like, if you make $3,000 every month, you're just going to pay $300. That would be a lump sum, a fixed amount. Payroll tax is based on the amount you make. So that's going to become progressively higher. So the more you make, the more you pay. Sales tax is going to be based on the amount of goods or services you purchase. Profits tax would be based on the amount a firm's profits are. Property tax is based on the value of your property, and a wealth tax is based on somebody's wealth. And wealth is different from income because income is money you're earning through employment. Wealth is just already accumulated money that you've got invested somewhere. All right, and then lastly, this is going to be a distinction that we make a lot of hay out of, that we talk about quite a bit, and that's progressive versus regressive taxes. So progressive taxes people with more resources. Regressive has the effects of a tax on people with less resources. Right, so in general, people argue that regressive taxes are not ideal. They're bad because people with less resources, less means, When they bear the brunt of the tax, they can't make as much money. I mean, they can't afford it as readily as somebody who makes more money. And then we've got this idea of a marginal tax rate, which is just the percent increase for each change in income. All right, so we'll talk about these notes when we get back together. And tomorrow you'll have some practice to do. Have a great day.